Okay, everybody, let's take a look at some performance reports. Now remember, the actual report is done for some kind of a responsibility center. So it could be a cost center, a revenue center, profit center, investment center. Okay, and what we look at is the actual revenue and expenses, okay, against what the budget was. So the budget is the plan. All right, if this is what you planned and this is what came in, well, how different is it? And we call the difference a variance. Now, a favorable variance increases income. Okay, it's favorable if net income increases. All right, so income would be higher than budgeted and expense would be lower than budgeted. Okay, and an unfavorable variance is when operating income is lower than budgeted. So an unfavorable variance for revenue would be when the actual revenue was lower than plan. And an unfavorable variance for an expense would be when the expense is higher than the plan or the budget. Okay? And then there's a concept called management by exception, and what you do is you look at the big ones. All right? If you've got a variance report, you look where the large variances are, and those are the ones that you investigate. Okay? And here's an example of a responsibility center performance report, and this is a region, Midwest sales region, and these are all of our products, okay, Sun Chips, Doritos, etc., and these are actual sales. So we've got actual sales, and this was the plan. These are budgeted sales, and then we just take the difference, and the difference is the variance. Okay, so like for Sun Chips, the actual sales were $23.67. We planned on $2,400. What I do is I stop right there and I say to myself, that's not good, so it's unfavorable. With these variances, you must label it, whether it's favorable or unfavorable, or the answer is incorrect. It has to be there. Okay, you can't just skip it because you're not sure. And there's the difference in dollars. Doritos, your actual sales are $15,896. The budget was $15. That's good. Okay, more than we planned, so that's a favorable variance. All right, and then the other thing we've got is the variance percentage is calculated, and it's a percentage of the budgeted sales. Now let's look. These are all sales. Okay, so what we're looking for in sales is that the actual is greater than budget, and you can see in total our actual sales revenue is $47 million. We planned on 45, or say 47.1. We planned on 45.9, so that's definitely favorable. Okay, so if you were a manager, then what you would do is you'd look down here at the bigger percentages. There's an 8% right there, so this would be my most important variance. I'd look into to see what happened with Tostitos, you know, and you don't look at it to chastise people or to get after people necessarily. You might want to see maybe something was wrong with the budget or something else is happening in your market that you didn't know about. But that's where you start investigating. Okay? Now, performance reports are often presented in contribution margin format with a line called a segment margin. Okay, we'll take a look at that. And the segment margin is operating income generated by a profit or investment center. So not a cost center, not a revenue center. Okay, a profit, so they've got to have revenue and expenses before subtracting common fixed costs that are allocated to the center. In other words, we're dividing up the revenue and expenses between what is controllable by the manager and what is not controllable. Now, common fixed costs are what the whole corporation might have, and they're allocated a hunk of it, but they have no control over those costs. Okay, so we've got it two different categories here. We call them direct fixed expenses. Remember, the word direct means traceable. Okay, fixed expenses, they can be traced to the profit center. Okay, so direct is directly traceable to that center. Common fixed expenses cannot be tracked to the profit center. Okay. And here's an example of a profit center segment margin. And let's just go down the outline here. We've got sales revenue less variable expenses, so variable cost of goods sold, and then we just got a line here for all variable operating expenses. And notice that these are, this is in a contribution format again. Instead of a contribution margin, what we're looking for is a segment margin. Okay, that's the one difference. So we've got our regular contribution margin here. We subtract fixed expenses, separating overhead from other operating expenses, and then we've got a segment margin. Okay, and then subtract your common fixed expenses to get operating income. Alrighty, now you need to know how to be able to do this. All right, and it's not rocket science. It's not that difficult. And what we're looking at again is actual minus budget gives us a variance. Variance percentage, and then whether it was favorable or unfavorable. And notice that here's an example of, let's look at revenue first. There's sales revenue. Our actual revenue is $43.14. The budget is $4,300. More actual than planned. That's good. So that's favorable. But now let's look at cost of goods sold. Cost of goods sold was $17.28. We thought it would be $17.20. So it's a whopping $8 off, but that is unfavorable. Okay, it's a small percentage, and if you were a manager, you wouldn't pay any attention to it at all. Okay, and their fixed overhead is unfavorable. Fixed operating expenses are favorable because these expenses are lower than planned. Okay, so that's good. So there's our segment margin for 45, for 35. Common fixed expenses allocated to the profit center are 36. And we planned on 35. You're getting 36. You just have to eat them. There's a little bit of oversight, maybe, or feedback that might come from a segment margin, but these are just allocated corporate expenses. Okay. The next thing we'll look at is return on investment, sales margin, and capital turnover. This is how we evaluate, say, profit centers and investment centers, cost and revenue centers.